The year is 2026. Missiles are flying over the Middle East. Diplomats are scrambling, and in every corner of the globe, one question is echoing through trading floors, kitchen tables, and boardrooms alike. Where do I put my money when the world goes crazy? If you've been watching the markets over the past 48 hours, you've seen something strange. Gold is up, Bitcoin is down, oil is spiking, and a lot of people are scratching their heads, wondering why their digital gold isn't acting like the real thing. Here's the truth. This isn't random. This isn't new. And if you understand the pattern, you'll never be caught off guard again. Today, we're going to uncover why gold has been the ultimate crisis asset for thousands of years, and why, even in 2026, with AI trading bots and digital currencies, the metal is still sending one of the clearest signals when the world feels like it's on fire. Let's begin with numbers that explain what's happening right now. Number 1, gold has delivered a 209% real return over the past decade. That means if you'd put $10,000 in gold 10 years ago, you'd have over $30,000 in buying power today, after inflation. Real return here means returns after inflation, the purchasing power you actually keep, not just nominal price gains. Number 2, over that same period, the average cash ISA, basically money sitting in the bank, lost nearly 17% in real terms. Number 3, since January of this year alone, as geopolitical tensions have escalated, gold has surged while Bitcoin has dropped 33% from its peak. Now here's the question. Why does an asset first used as money in ancient Egypt thousands of years ago keep beating everything else when the world starts falling apart? The answer will change how you think about money. There's a concept called the Lindy effect. It's simple. The longer something has survived, the longer its remaining life expectancy becomes. A Broadway show that runs for a week might close tomorrow. A play that has run for a decade could run another decade. But something that has survived for millennia? Its remaining life expectancy is measured in millennia. Gold is the ultimate Lindy asset. The Roman denarius is a museum piece. The Spanish doubloon is a collector's item. The British pound has lost the vast majority of its value since 1900. The US dollar has lost the vast majority of its purchasing power since the Federal Reserve was created in 1913. But an ounce of gold, it still carries purchasing power across generations. When bombs fall, investors don't ask, what will perform best next quarter? They ask, what will survive the next decade? Gold answers that question with a track record that stretches across recorded history. So if longevity matters, how does gold perform when a crisis actually hits? That's next. Let's go back to 2008. Lehman Brothers collapses. The global financial system is hours from freezing. The S&P 500 falls 37% that year. What does gold do? It rises, about 5.8%. While banks were failing, pension funds were evaporating, and homeowners were walking away from mortgages they couldn't sustain, gold held its value and then quietly climbed. Go back further. 2002. The dot-com bubble has burst. The Nasdaq has fallen roughly 78% from its peak. Tech stocks that were going to change the world are wiped out. Gold, up about 24.77%. Fast forward to 2022. War in Ukraine, inflation surges, stocks fall, bonds fall, and the classic 60-40 portfolio suffers one of its worst years in generations. Gold, down only about 0.28%. In a year when almost everything else broke, gold largely held the line. This isn't a coincidence. This is what gold has been trained by history to do. Protect purchasing power when other assets are under siege. Now let's look specifically at the Middle East, because this is where the pattern becomes unmistakable. 1973, the Yom Kippur War. Oil markets are disrupted. Gold surges. 1979, the Iranian Revolution. Oil production collapses. Gold more than doubles. 1990, the Gulf War. Gold jumps initially, then settles once U.S. commitment becomes clear. 2003, the Iraq War. A similar pattern. rise before the war, then a pullback after the opening phase begins. 2020, the Soleimani strike. Gold spikes briefly, then gives much of it back. The data tells us something important. Limited strikes often produce temporary spikes. Regime change level conflicts can produce longer, structural repricings. And when regime change enters the conversation, markets start pricing in risks that aren't solved in a weekend. That's because regime-level conflicts change trade flows, credit lines, insurance costs, and reserve planning, forces that reshape markets for months or years. Now let's address the elephant in the room: Bitcoin. Bitcoin has been called digital gold for years. Fixed supply, decentralized, outside government control. It sounds familiar. So why in this crisis is Bitcoin down while gold is up? Here's the uncomfortable truth. Bitcoin is still correlated with risk assets, especially tech. When panic hits, investors sell what they can, not what they want. And Bitcoin, with 24-hour trading, high liquidity, and instant settlement, is easy to sell. Gold isn't as frictionless. You can't liquidate a physical bar with one tap on your phone. That inefficiency can be a feature in a crisis because it reduces forced selling. There's also another force underneath gold right now: central banks. Global central banks have been buying gold at unusually high rates, over 1,000 metric tons annually for 3 straight years. Why? Because of what happened in 2022. When the US and its allies froze Russian central bank assets, every central bank in the world got the message. Reserves can become political. China, India, Russia, Turkey, and Poland have all been accumulating gold and, in many cases, repatriating it. The United States holds the largest official gold stock, built up through 20th century monetary policy, wartime flows, and the Bretton Woods system, and stored at Fort Knox, the New York Fed, and West Point. Germany has long carried large reserves and repatriated hundreds of tons between 2013 and 2017 to bring custody back to Frankfurt. Italy kept sizable holdings after World War II and treats gold as a steady, sovereign hedge. France has managed large reserves since the 19th and 20th centuries as a core part of Banque de France's stability policy. Russia sharply increased purchases after 2014 to reduce reliance on foreign currency reserves and shield assets from sanctions. This isn't a short-term trade. It's a structural realignment in the global monetary system, and it puts a floor under gold demand that didn't exist in the same way before. A World Gold Council survey found that 76% of central banks expect to increase their gold holdings over the next 5 years. Bitcoin? No major central bank is accumulating Bitcoin as a reserve asset. Let's put this in perspective with numbers you can actually remember. Over the past 25 years, gold has delivered a 1,075% return. That's roughly an 11% annualized gain over a quarter century. Through dot-com crashes, 9/11, the 2008 financial crisis, COVID, wars, inflation spikes, and aggressive rate cycles. Look at some of the standout years. 2007, plus 31%, run-up to the financial crisis. 2010, plus 29.6%, post-crisis instability. 2020, plus 25.1%, pandemic year. 2024, plus 27.2%, 2025, plus 27% through July. And even in down years, like 2013, when gold fell around 28%, it was coming off a decade of strong gains. The point isn't that gold never drops. The point is that over any meaningful time horizon that includes crisis, gold has a long record of preserving and often growing purchasing power. For decades, Wall Street told you to ignore gold. Barbarous relic, they said. No yield, they said. Just a rock. Something changed in 2025. Morgan Stanley's chief investment officer, Michael Wilson, floated a new idea: a 60-20-20 portfolio, 60% equities, 20% bonds, and 20% gold. That is a seismic shift away from the old 60-40 model that dominated for generations. because bonds broke in 2022, and they haven't fully reclaimed their role as the default safe haven. Now you're seeing gold discussed more openly in mainstream finance because investors are looking for something with low correlation to stocks, resilience in crises, and long-term purchasing power protection. Gold also tends to have an inverse relationship with the US dollar. And when the dollar weakens, amid trade tensions, record debt levels, and renewed money-printing fears, gold often strengthens. So what does that mean for a normal investor? Let's make it practical. Here's where we are in February 2026. You've got a Middle East war that could escalate. You've got central banks de-dollarizing at a record pace. You've got debt spiraling. You've got inflation pressures that refuse to fully disappear. And you've got two assets people keep comparing. One trusted for thousands of years, and one that has been around for about 15. Does this mean Bitcoin is worthless? Absolutely not. Bitcoin may have tremendous long-term potential as society becomes more digital, but in this moment, with these specific risks, the market is sending a signal. Gold is up, Bitcoin is down, central banks are buying, institutions are pivoting. The consensus among many balanced portfolio analysts is to hold roughly 5% to 10% in gold, enough to cushion drawdowns elsewhere, not so much that you're overly exposed to gold's volatility. More aggressive investors sometimes go higher, 15% to 20%. But here's the key. Don't chase spikes. In limited conflicts, gold often spikes and then retreats, giving better entry points later. If the conflict stays contained, you may get those entry points. If it escalates, the structural bid from central banks means the floor may be higher than it used to be. When the world wakes up to conflict, gold tends to do what it has always done. It rises, quietly, confidently, without fanfare. Gold has watched oil embargoes and revolutions, wars and peace treaties, bubbles and crashes, pandemics and stimulus, interest rates at 0 and interest rates at 5. It has outlasted governments that tried to suppress it. It has outlasted economists who dismissed it. It has outlasted new asset classes that promised to replace it. And when this conflict ends, whether in weeks, months, or years, gold will likely still be there, doing what it has always done, holding value when confidence breaks. Charles de Gaulle once warned that betting against gold is effectively betting on governments and government money, against the weight of human history. In a world of endless noise, gold remains one of the clearest signals. When fear hits, there's a place the world's money still trusts. Something that isn't a screen, isn't a promise, and isn't a policy decision. It's a metal that, across history, has never had to be bailed out. So here's the question. In your portfolio, do you own the eternal signal? Not as a trade, not as a gamble, but as insurance. Something designed to help you survive chaos, not predict it. If you want to learn more about thinking about gold as a long-term wealth preserver, I've linked resources in the description. And I want to hear from you. Do you think gold is still the ultimate safe haven, or has Bitcoin earned a real place in the Crisis portfolio? Drop your take in the comments. If this video gave you a new way to think about what's happening, hit like. It helps more people find it. And subscribe if you want to understand markets, not just follow them.